Hello, and welcome to episode 130 of the REconomy Podcast, where we discuss economic issues that impact real estate, housing, and affordability. If you find this type of real estate economic discussion valuable, please be sure to hit the like button and subscribe to help us grow this podcast. I am Odeta Kushi, Deputy Chief Economist at First American, and here with me is Mark Fleming, Chief Economist at First American. Hey, Mark, we're heading into the holiday season, believe it or not. And because of that, we're going to take inspiration from a movie you reference every single holiday season, The Year Without Santa Claus.
Yes!
Specifically, we're going to borrow from your favorite duo, Heat Miser and Snow Miser.
Even better. Finally, it's been almost 5 years now of the REconomy Podcast episodes, and my claymation moment has finally arrived. But I am wondering, where are we going with this? How exactly are we weaving a 70s claymation Christmas classic into a REconomy episode?
Well, I'm so glad you asked. I did have to give it quite a bit of thought.
Sure.
But if you hadn't heard, the Fed has a rate decision coming up on December 10th.
Yeah, I've heard, but still, claymation Christmas and the Fed. I'm not getting the connection yet.
Well, then you might have also heard that the market has been pretty split on whether we're even getting a rate cut in December. There are reasonable arguments in both directions, so I figured today to lay out those arguments, why not embody the debate? So you're going to take on the role of economic heat miser, arguing for a rate cut at the December 10th meeting to heat up the economy, and I will play snow miser, arguing against a rate cut.
So no Debbie Downturn today, but instead Snow Miser, like Snow Miser?
Yeah, but I mean, is Snow Miser really that different from Debbie Downturn?
Exactly.
Now, before we dive in, important disclaimer here, we don't necessarily believe the positions we're about to argue. This really is an exercise in thinking through the data and the risks on both sides. And on that note, let's just set the stage a little bit before we go to turn up the heat or the snow.
Sounds good. So a quick status check on the economy, so we're all working from the same baseline. To gauge the health of the economy, we look at GDP growth, which remains pretty solid. Real GDP posted a quarter-over-quarter gain in the second quarter, following a decline in the first quarter, and all indications are that the third quarter will be solid too. Although the average increase over the first half of the year was slower than the average pace of growth throughout 2024. And the labor market has cooled down. There are fewer job openings and hires. Wage growth has decelerated from very elevated levels, and job gains have downshifted from their earlier pace. But the unemployment rate is still historically low by any reasonable long-run standard.
That's right. I mean, when it comes to the labor market, we're sort of in this low hire, low fire environment. I've heard it called a frozen labor market, and I think that explains it well.
No Snow Miser yet. No Snow Miser yet.
I did sneak that in there.
Exactly. So on the economic front, the classic economic jargon, we're not too hot, not too cold, we're pleasantly lukewarm.
That's actually not a thing.
It is in Heat Miser's world, of course. But also, not to sneak him in too early either. And on the inflation side, there has been a lot of progress. Headline and core inflation are way down from their 2022 peaks. But on a year-over-year basis, the Fed's preferred personal consumption expenditure, or PCE, inflation measure has been stuck above 2.5%. The latest data has it around 2.9%, which is now significantly above the Fed's 2% target. So that's our backdrop. Inflation progress has been made, but it remains stubbornly elevated. Growth is slower, but the economy continues to demonstrate resilience, and a labor market that's cooler, but, by all intents and purposes, still intact.
All right. Well, we've set the baseline. So now let's turn it over to the misers. We'll start with Heat Miser first. Why should the Fed cut in December?
Thank you. Cue the trombones and straw boater hats, which, by the way, I did have to Google to figure out what to call those hats. Picture me with flaming red hair. I can see that. Curly tipped shoes and a slightly concerning laugh. Now we've painted a very scary picture.
Yes.
From Heat Miser's perspective, while inflation is not back to 2%, a recent study from the Federal Reserve Bank of St. Louis indicates that the core PCE rate without tariffs would have been about 2.5% instead of the reported 2.9%. Some of the recent stickiness in inflation has come from tariffs and goods prices, not from a broad reacceleration across the entire economy. That's important because tariffs are often seen as a one-time level increase in prices. You raise the tariff, prices jump, and then it's all done and in the base. But unless you keep ratcheting tariffs higher and higher, it's not a source of ongoing inflation. In other words, to borrow from the Fed's lexicon of the early pandemic, you remember this, right? Tariff-induced inflation is transitory.
Oh, goodness. There's that transitory again.
Exactly.
But you know what? Inflation isn't just about the goods sector.
That's right. We're mostly a services economy after all. And on the services side, which is where the Fed has been laser focused, the story is very different from 2022. Services inflation is heavily driven by wages, and wages are heavily influenced by the quits rate. When workers are quitting jobs left and right, they're usually trading up to higher pay, and wage growth accelerates. But today, the quits rate is down substantially. Workers are staying put. That's a strong signal that the wage growth is likely to remain contained, and with it, services inflation. So from Mr. 101's perspective, the underlying engine that would push services inflation higher just isn't running that hot anymore. Then there's shelter. We know that official shelter inflation measures are slow to adjust. They lag what's happening in real-time rents by quite a bit. New lease rent growth has already cooled substantially from its peak and has slowed to below pre-pandemic average levels. That cooling is slowly working its way into the CPI and PCE shelter components. So even if these official shelter numbers still look elevated, you can see the future in the rental data. Shelter inflation is going to continue to decelerate. So let's put these pieces together. Tariffs, a one-time transitory price shock. Wages and quits are pointing to limited service inflation pressure, and shelter inflation is set to slow as it catches up with their rental reality. So Mr. Green Christmas here sees an inflation outlook that's much more benign than the headline numbers might suggest. And oh yeah, I am just too much.
Oh my goodness, too much indeed. Okay, I do see your point. Although inflation is only one part of the story, the other half of the Fed's mandate is full employment. If your argument is that Fed should cut rates, then what you're really saying is that they should look through stubborn inflation and focus on labor market deterioration.
Exactly. The job openings rate has come down, the hires rate is low, and firms are clearly more cautious. This isn't the overheated labor market of 2021 or early 2022 anymore. When the hires rate is this subdued, it is a warning sign. Firms aren't hiring much. When they do adjust, it's easier for unemployment to drift even higher. You don't need a wave of layoffs. You just need weaker hiring and normal churn, and the jobless rate starts to climb. That's what's happened actually this year.
Not to mention that continuing jobless claims are elevated, which is consistent with a labor market characterized by a slow pace of hiring.
That's right. And so from Mr. Heat Miser's perspective, that's the real risk now. Not that inflation suddenly reaccelerates, but that the Fed keeps policy too tight for too long and the labor market weakens more than necessary. If the Fed waits until unemployment is clearly rising, then it's already behind the curve.
All right, so let me get this right. Your argument for a cut is that the remaining inflation pressure is mostly about tariffs and lags, not a new broad demand surge.
Right.
Services inflation is unlikely to accelerate with low quits and moderating wage growth.
Mm-hmm.
Shelter inflation is on track to decelerate as the data catches up to slower rent growth. And the hires rate is telling you the labor market is vulnerable. Unemployment can drift higher from here if the Fed doesn't ease off the brakes a little bit. So a small cut in December is Heat Miser's way of saying, we've done the hard work, now let's avoid overdoing it.
Yeah. Is it getting warm in here? Mr. Heat Miser rests his case.
All right, more trombones and straw butter hats, please.
There we go.
Snow Miser is here to throw a little ice on those flames. Now, I actually agree with a lot of your diagnosis. Tariffs are seen as a one-time shock. The quits rate tells us a lot about wage dynamics, and the rental data strongly suggests that shelter inflation will keep cooling over time. Those are all reasons to think we're much closer to the end of the dark inflation night than the beginning. But the Fed has seen false dawns before. And if the Fed cuts too soon, they risk turning what could have been a one-time bump into a more persistent problems. Even if tariffs are a one-off, they still show up in the headline numbers. The Fed is trying to re-anchor a credibility story that was badly tested in 2021 and 2022. So from that perspective, cutting into a tariff-boosted inflation reading, even if we think it's transitory, can be a tough communication challenge. And on the labor market, yes, the hires rate is concerning. And yes, that could translate into higher unemployment if it continues. But from Mr. Icicle's point of view, the question is, Has the labor market cooled enough that we need to act right now? Or is there still room to wait for a bit more confirmation that unemployment is actually drifting up, not just at risk of doing so? The economy is also demonstrating resilience, as is the US consumer.
Okay, Mr. 10 below. Good counterpoints and exactly why the Fed is stuck in a real policy conundrum. Stay put and risk tightening too much, or hit go on another cut too soon and risk reigniting inflation. Dare I say, a version of the should I stay or should I go?
Oh, you should dare not.
I should dare not. That is classic Clash. We can't let a 70s Christmas reference to a movie in the 70s count as our 80s pop reference. And what's extra special about this one is that Should I Stay or Should I Go was actually re-released in 1991. So, decadal hat trick in this episode.
Well, at least you reference one of my favorite decades here. But
Exactly.
you're right. These are not, right versus wrong positions. There are different ways of weighing the same data and risks. Okay, let's do what we do best and connect this whole Fed question back to housing. If the Fed cuts in December, will mortgage rates fall?
Well, not necessarily, but it does increase the odds that they drift lower or at least stay contained. The Fed's fund rate is a short-term rate, while mortgage rates are long-term rates. But the Fed's moves influence expectations, volatility, and that all-important mortgage treasury spread. If the market sees the cut as rational response to falling inflation and slower growth, longer-term yields and mortgage rates could be a little lower than they would have otherwise been.
Right, but it's not that simple because sometimes when the Fed cuts, markets worry that the Fed is behind something and longer term rates don't move in lockstep. It depends on why they cut and how the market interprets it. So a cut is neither necessary nor sufficient to guarantee significantly lower mortgage rates.
That is so very true. So if you're still listening to this after all these terrible references to heat miser and cold miser, and you're wondering, okay, but what do I do with this? The answer is you probably don't want your entire housing decision hanging on a single Fed meeting.
Yes, I mean, whether the Fed cuts in December or waits until a later meeting, mortgage rates are still likely to be in a relatively similar range, somewhere in that mid to low 6% neighborhood for a while, barring a big surprise. We're not talking about going back to 3% next week, and we're also not talking about going to 8% next week.
Yep, the bigger considerations, as always, are your income, your job stability, your time horizon in the home, and what's happening in your local market, local levels of inventory, price trends, and rents.
And if you're already a homeowner, a lot of your experience is shaped by the fact that your mortgage payment is fixed. Even in a higher rate world, that stability can be a powerful hedge against inflation over time.
I think we need to call in Mother Nature and Mrs. Claus to finally settle this debate between the brothers miser.
All right, before you reference every character in this movie, I think we're going to need to close it up for today.
Fair.
Whatever the Fed decides on December 10th, we'll be back to unpack what it means for the broader economy and, of course, the housing market. So thank you for joining us on this episode of the REconomy Podcast. If you have an economics-related question you'd like us to feature in the future, you can email us at economics@firstam.com. And as always, if you can't wait for the next episode, you can follow us on X. It's at Odeta Kushi for me and at Fleming Econ for Mark. Until next time.
I'm Mr. Heat Miser. I'm Mr. Sun. I can't remember the rest of those lyrics. I need to watch
Time
it
to
again.
rewatch, I guess.
Exactly.
Required watching.
Thank you for listening. You can find even more economic content at firstam.com/economics. This episode is copyright 2025 by First American Financial Corporation. All rights reserved.